Welcome to Sir Lancelot's Real Estate Roundtable, your guide to mastering the realm of real estate in Central East Florida. I am Sir Lancelot Leonard, ready to uncover the secrets of seller strategies, home staging, mortgage mastery, and more. From Daytona Beach to Cocoa Beach, Lake County to St. Augustine, join me as we navigate the intricacies of real estate. As the leader of the Sir Lancelot Group at Florida Homes Realty and Mortgage, I'm here to arm you with knowledge and innovation, whether you're a seasoned homeowner or a first-time buyer, unveiling the kingdom of real estate, one roundtable at a time. Welcome back to another powerhouse episode of the Real Estate Roundtable. Today, we're diving deep into the world of short-term rental financing with an absolute expert in the field, Jeff Chisum. Jeff isn't just a mortgage professional. He's a game changer in the STR investment space, helping investors leverage creative financing solutions to scale their portfolios from 10% down second home loans to DSCR financing and even 100% financing for vacation rentals. Jeff knows how to make STR ownership accessible and profitable. If you're looking for financing strategies that work in today's market, you need to hear this. Let's go into it. Jeff, I want to paint a scenario here. A real estate investor has their eye on a perfect short-term rental property. Maybe it's a cozy mountain cabin or a sleek beachfront getaway. They're excited, but then the financing hurdles hit them like a ton of bricks. Traditional loan options don't fit. Banks are skeptical about STR income, and the dream of scaling feels out of reach. Enter Jeff Chisum. What's your first move to help them unlock the best financing solution?
Well, and I loved how you paint that picture because, yeah, that's kind of our niche is lifestyle assets, or these properties that are in these destination type areas, like the mountains and the coastal areas. So I love that introduction. But yeah, in your scenario, I'm going to tell that client jump into the pre-approval process, because it's kind of like going to the doctor and telling them that you feel bad, and they look at you and say, well, let me tell you exactly what's wrong with you. It just doesn't happen. So if you want to keep kind of guessing what the best fit is going to be or what the solution is going to be, just keep thinking about it's not going to work, right? So you've got to jump into you know letting someone deep dive into your file, because, and with an expert. So we stick with that kind of medical analogy. You got a problem with your knee, you go to your general practitioner, they can tell you some things about the knee, because they know anatomy. They went to a lot of school, but an orthopedic is going to be able to you know order the MRI and look at all the details of the structure of the knee to tell you exactly what's wrong with it. So that would be my first suggestion. And in our case, we can do a soft pull on the credit. So it's not anything that's going to ding your score or go as an inquiry. You're not going to get 30 or 40 phone calls from, other lenders, because the bureau sold your information from that hard pull. So, with our application, it is not product specific. So that one application allows us to look at all the products. So, we literally are kind of a breath of fresh air to those investors that don't fit in that box, which typically, if you're not W-2, you don't fit in that Fannie or Freddie box. So we're going to look at DSCR. We're going to look at the debt service coverage ratio loan, where we can use short-term rental income for an approval versus your personal income, which on the DSCR loan, for those that don't know, we're not looking at personal income whatsoever. It's, do you have the acceptable credit score, the ability, typically, what's most common is to put down 20%, have 6 months in reserves for the PITI payment. And then from there, it's in these destination areas, because that product was created for long-term rentals. They're looking for a 1-to-1 ratio. So gross income that would match the principal, interest, taxes, and insurance payment. We're blowing that out of the water in the short-term rental market. And then there's there's bank statement loans. So we're looking at bank statements to extrapolate a qualifying income versus looking at your tax return, where you did everything that the law will allow from a write-off perspective. You know, it's not a true reflection of your actual income, but a bank statement is. So there is a 10% down option there, uh, on the second home occupancy loan. So that is an opportunity as well, because people love that 10% down option. Any way that you can keep cash in your pocket, a lot of times is gonna make for a more successful venture in this space. So sorry, long answer for maybe a short opportunity there.
Let's dive a little deeper. Hey, Jeff, let's dive a little deeper into this. You specialize in creative financing strategies that most, investors don't even know exist. You touched upon it briefly with a 10% down second home occupancy loan. What are the requirements and what are some common misconceptions investors have about this option?
Yeah, so the 100% of my business is helping clients with STR financing. About 90% of my clients are using the 10% down second home occupancy loan. Now, I will say, out of the 90%, probably 89% have some type of W-2 income. So, it has a debt to income ratio standard. But kind of the catch there is that we can't use any of the income, projected income from the property towards qualifying. So you have to be able to qualify, with being able to absorb that payment into your ratios. Um, so yeah, that's our most popular option. People are typically going to exhaust that lane as far as they can take it. A lot of misconceptions there are that you can only have one of those loans. You could potentially have 10 of those, um, because you can have up to 10 mortgages in your name with by Fannie and Freddie policy, and there's nothing to say that all 10 of those weren't originated as the second home occupancy loan. Um, we get distance, information around the distance requirement. There is no distance requirement. You can have a property manager. That's misinformation I see out there. Um, but yeah, it by far is our most popular option, because beyond the 10% down opportunity, that product is going to give you the better of the interest rates, outside of a primary residence.
So you're saying if I would like to buy my neighbor's house, I could do that with this loan?
No,
No.
no, yeah, good question though, because it's got to make sense. So kind of a scenario, you know,
'Cause look, I live in a beach town. Let's say this. I live in a beach
yeah,
town.
yeah,
I own my house west of 95, but I would like to have a condo on the beach or a house on the beach as well as my second home, just so on the weekend we can go there with the kids and play in the sand. Would that be an option for me, or it has to be further
now,
away? Same
yeah,
town.
now you're, yeah, now you're talking. Yeah, now you're talking. And that was kind of the scenario I was going to paint as, you've got kind of an area that is by water or by a state park, something like that, and you go on a regular basis. Maybe you even have a boat down there, and now you want to own something, so you're not having to go back and forth, when you want to go and spend time there. So that would make sense to an underwriter. That's kind of one of those makes sense. Now, if you live in a subdivided neighborhood and across town you want to go buy another, single family home in a subdivided neighborhood and use the second home occupancy loan, that doesn't make sense. But your scenario is, I wouldn't say quite common, but it is one that we've done deals for with that 10% down second home
Like,
occupancy loan.
call it basically like a vacation home.
Yeah, yeah, it just makes
Used to be
sense,
a
and that's
thing.
yeah, yeah. Well, and we've even had it where people have bought a second property using that 10% down in the same market area. So let's say, really popular area to buy short-term rentals is the Smokies. You go and buy
Yeah.
one. You go buy a, 3-2 cabin, not anything special, just, basic standard cabin. Uh, you own it for a year, you're renting it out on Airbnb, Verbo, everything's working great, but what you're finding is that it just doesn't meet the needs of your family. You can't bring extended family. There's no, space for amenities like a game room, and you find a, 5-4 uh, on a hilltop with an amazing view. It's got an indoor pool, it's got a big game room, and you explain that to the underwriter in a statement that that's why you're buying another property in this area. You're going to use the 10% down second home occupancy. That makes sense. So I've kind of coined that phrase, the bigger and better rule, when people want to buy another property in the same market area using that product. So it's bigger and better. You want to think bigger and better.
Okay. So then there's the DSCR loan, an absolute game changer for investors who want to qualify based on, rental income rather than a personal income. But not all DSCR lenders are created equal. What are the key things investors should watch out for when they're choosing the right lender?
Ask for their license number.
Okay.
Yeah, not even a
Seriously, that's a
joke.
thing?
Not even a joke. Because the DSCR loan is a non-qualifying, non-QM loan, so you're not qualifying based on your ability to repay. So it doesn't go into those standards that are regulated and governed, and require all the disclosures, and it has to be originated by a licensed loan officer. So the DSCR loan is literally like the wild, wild west. Anybody can originate it for a company that knows how to do that kind of business, and they can do it all across the United States. So you've got, and I did like 4 podcast episodes on my podcast where I just went off. I was seeing all this, these people on social media that were saying, it's not going to report on credit. You can do this, you can do this, you can do this. And on the other side, I was hearing all these stories where people were coming to me and said, "Well, I went with this lender, we got into the deal, and they came back and said the interest rate's going to be higher. They're going to have to put, I'm going to have to put, 5% more down, 10% more down," and it was just happening over and over again. So that's number one: is ask them if there's a licensed loan officer, because they understand, hey, there's some rules that you have to be played by. You just can't just tell anybody what they want to hear. And you got to know what you're doing. The other thing is, um, and this is typical with brokers. Brokers have their place. I'm not going to badmouth them, but it really matters when it comes to your relationship with the investor that you're working with. You want to know what their appetite is. And so to say, I'm going to go shop your deal and find you the best deal out there, that should be a red flag that they potentially are not familiar with what their appetite is, what their rules are, what they're looking for. And that could turn into a situation where they come back, and because they're not familiar with what they're looking for, where they say, yeah, you're going to have to put more down, the interest rate's going to be higher. The other part of that is just control of the process. Just asking, do you ever lose control of the process? So in our situation, we're delegated with the investor, where we process the loan, we underwrite the loan, we uh, close the loan, we fund the loan as well. Each of those steps along the way, if you're having to send that out to an investor to have it get done, those are potential delays. So you never want to it's never a great situation when you're in a 30-day contract period and you hear the lender tell you, when you check on the loan, you haven't heard from them for a week, and they tell you, well, the investor has it, they're reviewing it. They just don't have control of that situation, and it's 3 days before closing. You're talking about having to extend. You're working with the seller that doesn't want to extend. Your money's on the. Are you stressed out yet? I mean,
Yeah. Been through that a few times, my friend. I've been through that a few times on the real
yeah.
estate side of things. Although I have my NMLS number, I have a license to be a broker as well. I just found out today that I needed a state live scan for my renewal of my license, and it was like God, I did the federal one. Why isn't that enough?
Right, right. Yeah.
Like, we have the federal, but we don't have the state. I said, isn't the federal higher than the state? Like, whatever. Just pay us more money, get some more things done. That's all it is at the end of the
Yeah.
day.
Well, and you know the complexities of originating a loan, and so and everything that you need to know, all the policies and all the
Yeah.
things. I mean, a monkey can't originate a loan, and so to have somebody that who knows what they were doing yesterday, and now they're going to originate your loan because they don't need a license. That's crazy to me.
That's a red flag. That's a red flag right there.
Yeah.
And then there's what sounds like the holy grail. 100% financing for STRs. People people hear that and think, wait, is that even possible? What does this financing option really mean and who qualifies? Because I've only heard 100% financing for VA myself. So tell me about this. This is an interesting product.
Yeah, so it's a strategy. It's a strategy to leverage equity, static equity that we have in real estate that we own to be able to go out and buy additional assets. So
This is not for
uh,
everybody. You have to be a homeowner or somewhat like have some
yeah, you have
equity.
to own. Yeah, you have to have some equity. So what I'm talking about is leveraging a HELOC to fund your down payment and closing cost to go purchase the loan. So a lot of people will hear that and think, okay, well, I'm going to go get this HELOC and then I'm going to use that to go and pay cash. Well, you just over leverage that piece of real estate with this additional debt. That's not what I'm talking about. So typically, what people are doing, and I did a podcast that episode that goes into some of these nuances called "Create Your Own Down Payment Bank," and the things that I talk about are not over leveraging, not overextending yourself, but it is a way to separate that acquisition debt from this other debt against the property. And then the expectation is that the acquired property is going to perform at a level where the burden of repayment is on that property for the HELOC. So your HELOC is not, you've got $500,000 in equity, you're going to go buy a $350,000 house with a line of credit. It's just going to fund that $50,000 10% down payment or the 20% down payment and closing cost. So that's where we come up with 100% financing. So, it is an acceptable source of funds because a lot of times you'll hear, well, you can't use a loan, borrowed money can't is not an acceptable source of funds for your down payment and closing cost. The only time it is when it's a loan against real estate that you own. So that's what the
Ah,
100%.
that's a good
Yeah.
trick. That's a good trick. I was thinking the same. So just so you know, I do construction as well. So I'm working on lining up building houses, and I was like, wait, why don't I get a HELOC out of my house and then I could build a house, etc. But this might even be a good option for fix and flips and investment properties, whatnot, to get that loan strategy that you're talking about. I think it's great.
Yeah. Well, and I've got a unicorn coming up because one kind of the holy grail is where do I find a HELOC for an investment property? They just kind of disappeared, when things started heading south a couple of years ago. We're going to have access to a HELOC for investment property. So we're
Ooh.
excited about that. Um, yeah.
I have
So,
one that has about what $350,000 of equity sitting in it, so definitely could unleash I could grow my portfolio probably by six more units for that money.
yeah. Yeah. I mean, it's, we're going to use other people's money to go out there and grow our asset base. And, that's a great way to do it, as long as for me, the way that I look at it, that property should perform in a level where it can pay back that debt.
Yeah, of course. So it's mostly like short-term rentals and VRBOs, Airbnbs, et cetera, that actually produce the income necessary to pay both loans back. Because in today's market, you and I both know like 6, 7, 8%, 9% interest on investment properties, even if it's seller finance between 9 and 12, like a hard money loan. It's like so hard to crank out any cash flow out of those properties if it's a long-term rental. it's just much tougher in that sphere at the
Yeah,
moment.
yeah, yeah. Those deals they're out there in the short-term rental world. So it's not every deal, but yeah, you've got to know your numbers. That's the other reason why I think it's important to be pre-approved, because you want to know that debt load servicing piece of the equation. You don't want to just kind of guess at those numbers, because you get into the deal and then you're like, oh, yeah, whoa, 8%. I didn't know how that was going to affect things. I thought it was going to be more like 6%.
Yeah. So, Jeff, you don't just provide financing, you help investors build strategies. What's one of your favorite stories or success stories where an investor used one of these loan products and totally transformed their portfolio?
Yeah, so I tell clients all the time, we're not usually working on a deal with someone. We're usually building a relationship because they want to build a portfolio of these products. So, really it's been a matter of educating people on the loan products that they didn't know were available. So I get all the time, Jeff, I wish I would have talked to you a few years ago, because I wouldn't have had to put down 20%. I could have just put down 10%, or I could have done this much sooner if I knew I only needed 10% down, or I knew that there was a product where I didn't need my tax return to qualify to do it. So, really it's been equipping people with information about what's possible. But then it's just the validation. I know I'm kind of keep bringing up the importance of this pre-approval process, but when I've got a website that's kind of designed to, I tell our story about investing and then I ask some questions. And one of those questions is, what is your price range that you're looking in? And it starts at, like, I don't know, 100,000. It goes up to 2 million plus. And then one of the choices is, uh, it depends on what you tell me. And I will say probably 40% of the time people are checking that box because they're just not quite sure. So, I really think that there's a lot of people out there that don't take action because they just don't know where they stand with things. So, yeah, that's my best answer is, we're just providing people with really good information that they didn't have before, and it's putting in a and the validation, and it's putting them in a position to be able to take action.
So, we just touched on this. I have a question about what's the first steps. First steps is we just get that pre-approval, guys. It is really important. Uh, everybody who's listening, first steps, get your pre-approval. Between you and me, you're a businessman yourself. I'm a businessman. I own several companies. To get a regular mortgage is insane. How much paperwork I need to provide. But
Mhm.
you're looking at your products. I don't know if the STR, but I know that the statement loan is so much less. It's so little stress involved in that because I don't have to pull 2 years of tax returns and then all the business P&Ls and then all the business this and all the business that and it's just I have a file. I think I have like 50 pages of PDFs in there. That's for like, oh, if I want to apply for a loan, I have this 50 PDFs that I need to send.
Mhm.
No, how much more simpler that is. In your case, is the STR like that too? And the statement loan the same way, or is it different a little way?
Well, and it's, when it comes to bank statements in the day and age that we live in, it's, back not too long ago, it was sitting at the fax machine for, 45 minutes while you're running all these pages through to send to the mortgage guy. And, everything's online these days. So it's super easy to, get that information over. So you're right. It's less of a hassle, but I will say the DSCR loan is the absolute easiest loan that we do. And when I have consultation calls with clients, and one of the questions that I ask is if you're self-employed, and when I see that, we tend to kind of go down that road of DSCR bank statement loans. And a lot of these business owners will tell me, hey Jeff, I've been through a few loan processes, and your DSCR loan sounds great because you're telling me I'm just going to fill out the application, pull credit, and maybe send in a couple of things, and we're done. So just send me down the path of least resistance. So it's easy.
It makes just a lot of sense as a business owner. Like, hey, I'm a busy man. I run around all day. Not everybody can afford a CPA or an accountant to be on his team direct with all the paperwork ready to send over to a bank. So if you're a busy guy and you're doing your business, a contractor, for example, that runs his contracting business, is out on the field 8 hours a day, asks like, "Hey, I want to get a loan," and they tell him is like, "Hey, you need to provide me with this 50 item list of things," and he's like, "Oh my god, it's going to take me a month to gather all that information. I'm going to miss out on the house I'm looking at. Blah blah blah. Here you go, DSCR loan, short, and sweet, basically." Correct?
Yeah, that's exactly right, and yeah, that's a common scenario.
A little higher
Most of those
interest
guys,
though. No, or
that's where we've seen the most downward movement on interest rates is with DSCR.
it's good.
So, where the gap used to be really wide, it's narrowed a lot lately. So that's been positive because, you probably been in this business long enough to know when we see some kind of reins being loosened in one area, it usually means we're probably going to see that follow somewhere else. And so we've seen, what the investors are looking for on DSCR loans. We've seen that loosen. We've seen the rates go down, so things are more competitive. So it's been, encouraging to see that. But yeah, you're right. You just don't want to be in the situation where you feel like the process is so overwhelming that, what you mean to do tomorrow turns into next week and the next month, and the next thing you know, it's a year later and you haven't done anything just because you were overwhelmed by the process. So yeah, it makes it a lot easier so that you can get to that position to take action a lot faster and a lot easier. Which that's, I tell people all the time, because I get asked, when should I get pre-approved? Well, if you're talking to me, you probably should get pre-approved, because if you took the time to talk to a lender, that means you're on Zillow, you're on Realtor, you got a realtor feeding you properties, and you just never know when it's going to happen that property, that great property pops up. Uh, you just don't want to be in a position where you're scrambling or you miss the boat because you've been waiting for, the right time to get that in place.
Also, what I'm gathering from this conversation right now, DSCR loans are not government-backed loans, so investors are running the show there, where we see a much more flexibility, much faster adjustment to rate calls by the Fed or anybody else. It's like, hey, we're lowering rates. You see a DSCR probably drop much faster than you would see a Fannie or a Freddie, because they have to go through all the government hoops and loopsies and before they start coming down. So if you're like in a situation where like, hey, Fed's lowering rates and the house is there, DSCR will probably catch up to a lower rate faster than a Fannie or a Freddie would, and you'll be like, holy cow, I'm almost getting the same rate as the other ones do.
Yeah, no, that's exactly right. And there's not as many outliers that affect the mortgage rates like they do on conventional loans. And there's big players, there's smaller players, and they all have different sources of where their money is coming from. Some is conventional means, so they are borrowing it through a bank or a federal entity where that Fed fund rate will affect it. But some of them are hedge funds, some of them are individual investors that are kind of syndicated together. But the nice thing is they're all competing against each other. And so, if they want to do deals, they've got to be competitive with their rates. And that's where we've seen DSCR has become a lot more popular than it was, a year ago, 2 years ago, 3 years ago in the residential space. And so, we're seeing that from a rate standpoint. They want to do these deals, so they've got to be more competitive with their rates, because we were in double digits this time, a little bit before this time last year. So we've seen about over a 2% decrease in rates over the
Ah,
past year
that's
in
good.
that space. Yeah.
So let's debunk some myths. Biggest misconceptions about STR financing, the costs, investors, opportunities. What's one?
Um, yeah, I would say there's just a lot of misinformation out there around policies about usage that, Fannie Freddie DSCR lenders have no problems with you putting them on Airbnb, Verbo. So it's, it, it is friendly towards renting those out on a short-term basis. You're not going to be limited by your usage. You don't have to use it a certain amount of days. Um, yeah, that's probably the biggest one I see. If you talk to another lender other than me, don't use the word investment property. Use the word vacation home because that'll put you in a different lane from a product standpoint.
I got you. I got you. So, how does the second home occupancy loan compare to a conventional investment loan?
Uh, the conventional investment loan is going to be more of a situation where you can use that market rental towards qualifying. So, it's going to be a situation where, uh, if your debt to income ratio is tight and you need to show some of that rental income to help you qualify for the product, then that's going to be the big opportunity there. Now, we have seen improved pricing on that product to where 15% wasn't even on the table, a year ago. I mean, 6 months ago, because the pricing was so ridiculous. We've seen some improvements there to make the 15% down Fannie Freddie conventional investment property more feasible. It is still a fully qualifying loan. The rate's going to be a little bit higher than the second home occupancy loan. But, and that's the nice thing. We get an application, we can look at all the opportunities, but the 15% is back on the table.
That's awesome. DSCR loan secrets. What strategies can investors use to maximize their chances of approval for a DSCR loan?
Oh, they're just so easy. I mean, you want at least a 680 credit score.
Okay.
Uh, you want to go into it with the idea that you're going to need at least 20% for an experienced investor. So an experienced investor is going to be someone that's owned a cash flow producing property for 12 months, for at least 12 months in the past 12 months. Now, we've seen exceptions to that. So we've had people that have said, well, I sold, a rental property 3 years ago, but I had owned it for 10 years before that. We've been able to qualify them as an experienced investor. If you're a new investor, you need to be have the idea to put down 25%.
Got you.
Now, on the other end of that, someone that is an experienced investor with, compensating factors like excellent credit score. The other one is you need that 6 months in reserves for PITI for that subject property. But the area that you're buying is, we're showing that you're well beyond that 1-to-1 ratio. The investor is uh, open to doing deals with just 15% down. So, really beyond that,
Yeah.
it really is the easiest loan that we do. But I mean, we know what we're doing and we know what we're working with, so that definitely matters. But yeah, if you have an idea of where you want to buy, that's helpful, because at pre-approval, that's the other thing, is how do I get pre-approved for a DSCR loan when you're not using my own personal ability to qualify? It's the property. We use AirDNA, which is a market conglomerator that's looking at short-term rental income, short-term rental data. So we can, going into the area, we're going to look at bedroom count, bathroom count, occupancy. And so we've done enough of these deals. We know what our investor wants. We can tell you up front whether, it looks favorable for an approval, which, 9 times out of 10 in these short-term rental markets it does. But yeah, those are the keys, is, over 680 credit score, the ability to put the money down and have the 6 months in reserves. And really beyond that, there's no tricks or tips.
That's awesome. That's good. 100% financing breakdown. How does someone qualify for 100% financing, and what's the catch, if any? It's the HELOC
Well,
version that we talked about. You need to qualify for a
yeah.
HELOC, obviously, and you need to qualify for the DSCR loan, or is it a different one? on that one?
No, I mean, yeah, you can use the HELOC for any of the loan products. So whether it's the 10% down or the DSCR, the acceptable source of funds can be a HELOC. So, the trick is going to be if you're the DSCR candidate, which, your debt to income ratio is exhausted, or you're that self employed person, you're going to need to use that DSCR. Uh, you probably should already have that HELOC in place already. Because if you don't, you may run into some challenges qualifying for that HELOC because, as far as I know, there's nothing out there similar to the DSCR on a HELOC where, they're not going to use your personal income to qualify you. So it's going to be, you got to have think of it like, if I can't qualify for a Fannie or Freddie loan, I'm probably not going to be able to qualify for a HELOC.
Okay, so that's kind of like the catch. You got to qualify for that HELOC.
Yeah, yeah, that's exactly right. Yeah.
Cool. So market trends, are you seeing any shifts in the lender flexibility when it comes to short-term rental financing?
Um, that is a great question. And where I've seen opportunities with lending that I'm trying to let people know about is we're more in a situation where we can ask for things. So, when you're working with your realtor, you want to be asking questions like, "Hey, what's my opportunity to ask for things?" So, will the seller pay for title policy? Uh, can we ask for seller concessions? So whether it's the 10% down loan or the DSCR loan, you can do up to 6% in seller concessions. So that's 6% of the sales price. So, if it's a $500,000 deal, potentially you could get 30,000 in seller concessions to go towards your closing cost, not your down payment. So that can go towards, bank fees, title fees, your prepays for your taxes and insurance. So it's a way to keep money in your pocket. The other thing that we're seeing is, sellers are just interested in a lot of deals just to how to get the deal done. So let's just get a deal done, which means they're open to talking and negotiations. So the other thing that is good to know from a documentable amendment standpoint is that you can write an amendment to the contract to ask for concessions towards appearance type improvements, so paint, carpet, things of that nature. Has to be paid, has to be held by the title company, so seller to the title company, they hold it. It's got to be paid to a contractor.
So that's
uh,
above the 6%, correct?
That is above the
How
6%.
about
Great question.
commissions?
That's outside of the commissions as well.
Okay,
Yeah,
so
so
6% for prepaids, closing costs, etc. Above that, you can ask for repairs. Above that, you can ask for commissions.
yeah, and I would say improvements. So
Improvements, yeah.
yeah, the underwriter's still going to want to see the bid from the contractor. So it really needs to be an estimate, a firm estimate for repainting and flooring, but they wouldn't want to see, something like repair the roof or
Yeah,
uh, you
something
know,
big. It has to be something that is more just beautification of the property, I'm guessing.
cosmetic.
Can't, yeah,
Yeah.
cosmetic. Yeah, it can't be anything structural or AC replacement or anything like that. Those need to be done anyways to get your insurance. So down in Florida, at least where we are, if your roof is older than X amount of years, you can't get insurance on it. You got to replace the roof. So that's on the
Yep.
sellers most of the time because hey, look, if we can't buy it, the next person can't buy it unless you find a cash buyer. But then they're going to beat you up on price. So either
Yeah.
ways, you're better off replacing your roof if it's
Yeah.
old. Yeah, yeah,
Yeah.
yeah.
Yeah. Pay that deductible. But yeah, so there's that people don't know a lot about because, we've been in a seller's market forever where, the rule is you don't ask for anything. Well, that's changing. We are able to ask for some things. So the other thing that I would say about those cosmetic allowances paid by the seller is you don't want to go too crazy. where an underwriter would say, well, we're going to have to get this thing reappraised and do an adjustment
Oh,
on the value. So you really want to keep it, from what I've seen and my experience has been with invest or underwriters, is 5% of the sales price or lower is going to keep you from, getting a situation where the underwriter goes, yeah, we can't do this. This is too much.
okay. Got you. What are three things an investor should do right now to prepare for a successful loan application? This is to fast track an approval. So before they contact you and before they start their application, what's three things that they need to do before that, basically?
Yeah, I mean, if you want to make it easier on yourself, have those documents lined up like the tax returns and 2 months of bank statements. But really, it's just a matter of taking that one step forward, which, is filling out the application. And then, maybe because sometimes you can kind of anticipate or assume what you're going to need, and then you end up not needing it. So, we don't like to over document our clients where we ask for things that we think we're going to need. So we just ask for what we know we're going to need, and then just prepare people. Hey, we may need some additional things later down the line, but we're not going to beat you up front. So, it may be an easier process if you just let the lender lead you through that, versus trying to anticipate everything that they may want, because you may just be overworking yourself.
Okay. And the last question here, are there specific tools, calculators, or platforms that help investors analyze financing options effectively?
I mean, there's some good market analyzers that are free out there, like Rabu, where you can go in and pull market data. So that's a good one. AirDNA is really developed and evolved over time to where they provide, not only market data, but now they're putting listings up that also have the data associated with it. So AirDNA is a good resource. That's what we use. It can be expensive, but you don't have to get a nationwide account. You can buy a subscription just for the market area that you're looking in.
For AirDNA as well.
Yep.
I used AirDNA before. It's not cheap. They went from, I think it was like $300 for the whole nation to $300 a zip code. I was like,
Yeah.
or like a town. I was like, God, that's now it's getting out of control here. Looks like a lot of people
Yeah.
are using it.
Yeah, no, that's exactly right. Supply and demand, they can charge, more than what they used to. But yeah, that's why I say you may not be interested in paying what the nationwide subscription is, when, you just need one market area.
Yeah.
But it's good information.
So, Jeff, this has been an absolute masterclass in SDR financing. For anyone listening who's serious about getting their next short term rental funded the right way, where can they reach you?
Yeah, so my website is the best way to connect with me. It tells a little bit about my story, our investing story into short-term rentals. Gets a little bit of information from you from the standpoint of like purchase price, where you're looking to buy, things of that nature. And then there's 4 videos that I put together that I used to uh, communicate all that information on phone calls. So we took that hour phone call, and now these consultation calls that I do are 15 minutes because of those 4 videos that I put together. So there's a lot of good information in there about products and the process. And then there's a link to schedule a consultation call with me where we can hear a little bit more about what you're doing. And then my podcast, STR Home Financing. So the website is strhomefinancing.com. The podcast on Apple and Spotify, same name, STR Home Financing. They're all 10-minute micro podcasts where I just take different subjects, different strategies, put them into one, 10-minute podcast, and then we move on to the next subject. So I think I'm up to like 60 episodes now. So, a lot of good information there.
Wow, that's good, my friend.
Yeah.
Yeah, congrats on 60. That's a big number. When you reach 100, we should pop a bottle of champagne for you.
There you go. Absolutely. Absolutely.
So the STR Home Financing Podcast, a must listen for investors looking to stay ahead of the game, guys. Well, we'll drop the link in the show notes. Jeff, thanks for sharing your experience with us today. And to our listeners, if you found this episode valuable, make sure to subscribe, leave a review, and share this with your fellow real estate investors. We'll catch you the next time, the Real Estate Roundtable. Thank you, everybody. Thank you for joining us on Sir Lancelot's Real Estate Roundtable, where we've unveiled the mysteries of real estate together. Remember, in this kingdom of possibilities, every dream home is just a discussion away. I can help your real estate dreams come true. Just call me at 786-449-7518. Until our next roundtable, may your ventures be prosperous and your homes be filled with love and joy. Farewell, fellow knights of real estate.